Thank you very much. Good morning, everyone. I'm calling to order a special meeting of the CERS retirement system. This was a trustee education session focused on investments. Mr. Bronco, would you give us our opening statement, please, sir?
Of course. This is a special called meeting of the County Employees Retirement System Board of Trustees. This meeting is being broadcast via video teleconference pursuant to KRS 61826 and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road in Frankfort, Kentucky. It's also being broadcast to the public via Facebook. If you are speaking and are not appearing by video, please identify yourself before talking. In the event the video or audio broadcast is interrupted, we will attempt to reestablish a connection. If a connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to a later date.
Thank you very much. Ms. Rankin, could you call the roll, please?
Yes, ma'am. Ms. Pendergrass,
Here.
Dr. Carver, Mr. Cheatham,
Here.
Mr. Foster,
Here.
Mr. Fulkerson,
Here.
Dr. Hackbart, Dr. Milkman, Mr. O'Mara,
Here.
and Mr. Powell.
Here.
Thank you.
Thank you very much. Do we have any public comment this morning?
No, ma'am, no public comment.
All right, thank you very much. As I noted earlier, this is an investment training session. So at this point, I'm going to turn it over to the Wilshire crew and hope their voice is not as scratchy as mine. Good morning, Wilshire. Take it away.
Good morning. All right, thank you. We're ready to take it away. I'll just quickly, Chris Tessman and I are in the room. You see us all the time. Also, we have Maddie on our private markets team who is with us today, and she's going to talk specifically about private credit, which is the largest component of our educational session today. And we also have Craig Morton on one of those pictures on the screen with us. So four of us from Wilshire. First section will be private credit. And I just want to say as we go through all of this, let this whole thing be as open as it can be. Questions for us, please bring them. The point of all of this is about education. The private and credit component relates to the asset allocation policy that has been discussed and not finalized yet. I'll come back to that in a minute, but we will also spend some time on three other topics. A little bit on rebalancing ranges. We'll talk about rebalancing and the ranges and how trustees should think about that, how a plan should think about that. The investment committee has asked us to bring a piece on fund governance, so we'll talk about that as well today, in some good depth, I think. And then finally, we were also asked to provide some information on sector and industry exposure within the portfolios. So we'll address that as the final piece of this. So we'll go over and have Maddie just lead us off with credit in just a minute. But I just want to back up and sort of set the stage for where this private credit is. And so in your asset allocation policy, you have a component called specialty credit. And so somebody had a question. Specialty credit in your case consists of two components. One of those is public credit and one of those is private credit. So our focus on private credit is just that part of that allocation. When we go through the asset allocation work with you and the asset liability work, we combine those two into one bucket so we can reflect the way you portray that in all of your materials. And just for your awareness or refreshing, we model that at 50-50, 50% public credit, which is high yield and typically below investment grade type things in the public markets. It's not the core investment grade fixed income. That is a separate allocation. So we have modeled this historically 50-50 between public and private credit. So, and this allocation of specialty credit is 10% in your current policy. And the policies that we reviewed in November with the investment committee and all that is yet to come through for final decision. That specialty credit component goes up quite a bit to 23 to 25% roughly across different portfolios and across the recommended policies that are being looked at. So you can think about that as that's sort of the portion of the portfolio that's represented by this specialty credit. So we'll just let Maddie lead it off on slide page 5 of your 43-page book, and we'll just try to be real educational about this and talk about what do we mean by private credit? What is it, and why are you investing in it?
Thanks, David. And like David said, I'd love to keep this pretty conversational, so please stop me if you have any questions at all. I'm happy to elaborate. But just to kind of kick things off, understanding private credit and really how it works. Private lenders loan money to businesses that are typically small to medium sized. The lenders control the term of the loan. So one thing we'll talk a lot about today is how control is really important for private credit. We'll also kind of contrast that to what it's like for public credit, which is a little bit different. But before we kind of get to that, the lenders control the term of the loan, and they also are able to kind of structure in these protections that you're not able to do in public credit. So some of those protections include collateral protection, for instance. An example of that that you might be more familiar with is, if you take out a car loan, that's usually, the collateral is your car. If you default on that payment, usually you get your car loan from a bank or other lender. They can come back and take that car and repossess it. So within private credit, assets that can be used as collateral can be a piece of equipment or really anything that's of value or just the cash flows of the business itself. And defaulting on a loan kind of allows, the lender to be able to either charge you a higher interest rate for that loan or take that piece of collateral. Another really common kind of structural protection that exists is covenants. You'll hear this a lot in private credit. It's basically an agreement that says, for the lender to say, well, we agree to lend you this amount of money at this interest rate, but there's some stipulations that go along with that. Like one common one is that, your debt level can't go above a certain level. So, they might be pricing in a certain amount of credit risk to loan you this amount of money, but if you go out and take out a bunch of other loans, then that increases your credit risk and they'll charge you a higher interest rate. So covenants allow them to do that, which in turn protects people that are also investing in private credit. So these loans are floating rate typically. You will see some fixed rate, but by and large, private credit is generally floating rate. This can be really beneficial in a rising rate environment, which is what we've kind of seen as inflation has been a very relevant topic, kind of in recent years. So as interest rates rise, like the interest rate that these lenders are charging borrowers also increases as well to kind of compensate for that additional risk. Why invest? Well, control, we talked about that. That's a big one. Huge advantage there. Also, higher yield, the liquidity premium, it's less efficient than public markets. So when you lock up your money, and we'll also get to that illiquid kind of characteristic that this strategy has, but locking up your money, you're going to get that liquidity premium associated with it. We have a question.
Excuse me just a second. Dr. Hackbert has a question and we want to get him on the roll call as well.
Absolutely.
Thank you. Go ahead, Dr. Hackbert.
Just two questions. Could you give some examples of the collateral that might be pledged?
Absolutely.
Number one. And also, you indicated that mostly they're floating rate. Can we also invest in fixed rate? Or are you just something that generally it's floating rates more normal, but are there options there?
Yeah, so I'll address the fixed versus floating rate question first. You can absolutely invest in strategies that do fixed rate. Most do floating rate. If you wanted to do fixed rate, invest in fixed rate, there's definitely opportunities to do so, but it will be more limited than floating rate. So it's just kind of a difference of, I guess if you want the fixed rate or the floating rate, and probably the answer may be both. So you can allocate to different strategies that offer both as well.
And what would be the types of collateral pledges that would be made? For example, I know on the overnight investments, typically there's collateral pledged for the investment in the state Department of Finance and so forth. Those overnights typically require collateralized. sources to pledge? What types of pledges would be made for collateral in these cases?
Yeah, absolutely. So types of collateral would be a common one is like a piece of equipment. So if they have, a valuable piece of equipment that the company owns, the lender might ask them to pledge that as collateral. Typically this is done when that piece of equipment is kind of, important in how they generate revenue. So that's a key one. That's a good example to kind of use of things that can be pledged as collateral. Within the case of direct lending, and we'll kind of get into the different strategies that fall within private credit, but direct lending is one of those strategies. Most direct lending strategies use cash flow based lending. So the collateral there, the collateral protection is the cash flows of the business.
How was the collateral evaluated? How is it valued? You said equipment. How is it valued?
So typically they'll bring in a third party, kind of valuation to look at that piece of equipment and give them an appraisal value. There are some strategies where they may do it themselves, and those are probably strategies that we don't really kind of like as much because there can be, more room for error. So we like to see when they are looking at like an asset and trying to put a valuation on that, we like to see, managers that use a third party valuation.
So the third-party valuations would be made available before you made a decision
Yes, that's
to make an investment.
Before you make the loan.
Is that routine, or is it
Yeah.
something?
So that's kind of part of the due diligence process that they go through before they actually decide to make the loan, is actually looking at the collateral and the value of it. So, it can kind of be evaluated using multiple different methods. Ultimately, it'll be dependent on what that third party kind of valuation consultant that they hire kind of wants to do. But, it could just be looking at like comparables, like say it's a piece of equipment, what is this piece of equipment sell for typically, or what's the price of buying it new? Or in the case of cash flow, it's looking at, well, what are the cash flows worth and how do we value the business as a whole?
So just to be clear on one of those points, if you're going to dedicate $100 million to a private credit fund, you've already done your due diligence on their due diligence into these lending facilities. So you have to be comfortable with the way that they're underwriting the process. You're not actually underwriting each of these separate loans individually. Is that clear, Dr. Hackman?
Yes.
Hackbert, sorry.
Yes, thank you.
And I would also add that typically managers will have a process for how they do it. So it would be very uncommon to, kind of see a manager that says, oh, well, we valued this way, and now we're going to value this, not using a third party, and they do a completely different methodology. So to Chris's point about being comfortable with how they evaluate things, there is a process in place that's laid out that you can ask about, while performing due diligence on the manager as a whole. So you're not going to be surprised if you see an individual loan that is valued some type of different way, essentially.
Mr. Cheatham has his hand up with a question.
Yeah, is it correct? My understanding is one of the reasons why we're seeing such an opportunity in this market is because the banking industry has slowly limited their exposure that way, but we've got a big refinancing pool coming at us over the next 10 years. Is that your all's understanding or where you're coming from as well?
So what we've seen in recent years within private credit, particularly with the regional banking crisis, is that we've kind of entered this risk-off environment for banks, and that's really given private lenders a lot of market share in terms of when the banks pulled back. That means less competition for the private lenders, and so they've really been. It's kind of been a very good environment that we feel for private credit in general. When there's less competition in the market, those private lenders are able to structure their loans in a way that provides them more protection instead of just being a price taker. They're now the price makers. So we feel it's been a great time for that, due to the banks pulling back. And that's also been a larger kind of tailwind for private credit really since 2008. You're seeing this kind of like resurgence with the regional banking crisis, but this is something that has been going on, really since the GFC.
Yeah, and Maddie will go through a chart in just a few minutes that'll show that over time. But private credit actually existed, even 20 years ago, but at a much smaller scale than it is today. And we had bank regulatory issues post the credit crisis that have essentially pushed some of this lending from banks to private lenders. And we've had even more of that in recent years. So it really has, there's been a pretty significant shift of lending to many of these businesses that has moved out of the banks and into private loan opportunities, all the things about terms that Maddie's been talking about. And also a lot of efficiency, I think, right? I mean,
Yeah.
a lot of these borrows are, sometimes they may not be all that long term, but they need the capital and they need it now. And so can be a faster process.
Absolutely. And actually,
Was there another question in the room?
Yeah, Dr. Hackbart has a question.
Yes, if the banks are backing out of these types of loans, is there concern with the potential risk involved in terms of their own structure and so forth? In other words, are these potential investments more risky, and that's why the banks are not touching them?
it's a fair point. So, one thing that came out of the GFC was that like this increased regulation, and part of that was requiring banks to be able to kind of manage their liquidity better. So these small and medium-sized businesses are essentially viewed as more risky than larger businesses by banks. And private lenders will have, kind of arguments like for and against that. But ultimately, what they feel private lenders look at is, what's more important than necessarily just the sheer size of the business is really understanding how they operate and the specific characteristics of the business itself. Private lenders are willing to really look at that business and dive into the due diligence in a way that banks don't really need to. They say, this looks complicated. I don't really have the resources to do this. So I'll just pass on it because there's a bunch of other firms that are larger and easier to understand, where these private lenders are really looking at this business. There's a complexity premium associated with it. So sectors that are often overlooked, or just business models that are often overlooked, private lenders are really able to kind of spend their resources looking at that business and making what they feel is a better and more holistic view of the actual credit risk.
Maybe talk about covenants that go into a lot of these loans. You had Cov Light versus how
Yeah.
now private lenders really get to structure that so that's from a risk perspective a big piece of this as well.
Yeah, absolutely. So one thing that you'll hear when talking to private credit managers is Cov Heavy versus Cov Light. Cov Heavy means that they structure in a lot of these protections. Cov Light means that they don't. Or they might say, yeah, we have a covenant on every single deal. But if you actually look at that covenant, they're set at a level that the business would probably just never reach. It would probably file for bankruptcy before it ever reached that level. So that's important to look at as well. It's not just, is there a covenant, but also where is the covenant set?
And just to add a piece to that, the initial part of Dr. Heckmark's question, also the industry, the regulatory environment has pushed a lot of this out of banks as well, because regulations have just tightened up on banks significantly in terms of their reserves and then what they can do with their reserves. So very different scenario when a private lender is raising capital and then lending capital, as opposed to a bank and its regulatory requirements and managing its deposits. This is a whole different process from that.
Yeah, and I think it would also be important to hit on, banks have to worry about deposits. That's why they have to worry about liquidity. Versus private credit managers, your money's locked up. This is an illiquid investment. We'll get to this a little bit later, but that's why they don't have to worry about that liquidity as nearly as much. So that also kind of explains, why banks face this regulation and why it's difficult for them to deal with versus how private lenders can kind of get around this.
Going to Dr. Hackford's question with regard to collateral, is my understanding correct? A lot of times the collateral that's being put up for these loans, they trying to think the best way. They've got a lot of equity built up in these pieces of equipment or whatever they're putting up. So you're really only loaning against, maybe you got a $100 million piece of equipment, but you're only loaning $50 million. Isn't that part of the risk profile that you look at on these loans?
Yeah, that's important to consider. Usually the assets that are, pledged as collateral are very important in kind of like the business generating revenue. So usually when lenders are looking to kind of select their collateral, they're choosing things that the business would have a very hard time if they didn't have this piece of equipment per se.
How liquid is the collateral?
It's a good question. Usually not very liquid, to be honest with you. If it's a piece of equipment, and they ultimately ended up kind of taking that asset. They have to find, sell it in a secondary market. But it is an important part of like the consideration when selecting the collateral. Like, could you actually sell this? So, I mean, it's not as liquid as, a stock or a bond, but it's, they're not going to pick something that they would never actually be able to sell or derive any value from.
And then in some cases, that collateral are cash flows,
Yep.
as Maddie mentioned earlier. So it's much different than when it's a piece of heavy equipment, for example.
Yeah, I would say it's a very broad range, but when we're looking at physical property, Lyle, to your point, I think the LTV typically loaned is it's coming in towards the balance of the favor of lenders, right? LTVs have come down. So again, if you have 100 million, you're not loaning 100 million on a piece of property or a piece of equipment that's valued at 100 million. It's a significant haircut. And then complexities, as Wilshire's pointing out, the complexities with liquidating in the event that there is an event on a loan, that's taken into consideration in how much is loaned against that property as well.
If no other questions on collateral, one more
I
question.
think there's one more.
Okay.
Mr. Foster, did
I have
you?
a question. Can you hear me?
Yes, sir.
Yes, Mr. Foster, we can hear you.
Okay, good. If I'm understanding this correctly, and I probably am not, but one of the primary motivations for private lending is to escape regulatory authority or have very minimum regulatory authority. And that also could create downsides to doing it, it seems to me. So what regulations would private credit lending be subject to?
I think it's important to point out that the reason that banks face regulation is to make sure that depositors are able to have access to their money and to their savings. The reason that private lenders don't have to, have this regulation is because they lock up your money. It's in an illiquid vehicle. And so they don't have to worry about managing that liquidity as much. You're not going to come and be like, hey, I actually need, this money, so you have to give it back to me.
Right.
There's none of that. It's let's just say it's a 7-year, vehicle, like the life of the vehicle is 7 years. They know that you're going to need your money back, plus the return that they're generating for you in 7 years.
Yeah, and I think two things. One, the nature of this asset class, like many other illiquid asset classes, is the expected returns are intended to compensate you for these differences. So yes, these are different than traditional corporate lending deals out of banks, but you're being paid for that. And then of course, what's critical is the due diligence. Critical is doing the work to understand the terms and the deals and things like collateral and all the things Maddie's been talking about. That's a critical part of this process. Also, much like private equity, it's a similar kind of thing where you're tying up capital to buy businesses. And so, but one comparison I would make is that this private credit is in private markets, just like private equity is in the private markets. These are areas that we expect to return more than public market investments. That comes with a level of illiquidity, but private credit is, although illiquid, in aggregate, much less illiquid than private equity is, because these are shorter terms. These are actual loans, and debt service is being paid, and that's being pushed back to the investors in the way of distribution. So it's a very different liquidity story than private equity. but it's all.
It can be significant. We usually often choose to reinvest them, given where we are. We have quite a bit of cash in most of the plans at this point. But previously in other investments or other plans that have been less funded that have invested, we just get the cash back. But that's an election we can make as the investors, especially with the managers that we have our own separate accounts with. So for several of them, we've just turned on reinvestment so that we can continue to have exposure to the new deals that they find for us. But should we just want income back, in principle, like Dave was saying, you're getting repaid much quicker than some of the private equity deals, which can sit out for much longer and not provide any liquidity for years. So.
Yeah, there tends to be a cash flow option, and specifically to the point, as opposed to regulatory, this tends to be contractual, right? So there's less of what we see is or we would view as that kind of that regulatory oversight that the banks have, and this is more of the agreements are contractual.
And they get played out in court. Like, I mean, you can see some of our managers that are involved in public situations. You can read the credit agreements that are posted online for public companies. We're signatories to some of them. And you can see what kind of term, like they were saying, and Wilshire was saying, what kind of terms did they get? What are the fees, or what is the interest being charged? Different terms that are public can be seen. So it's not a regulation evasion thing. It's just private contracts that are being done between companies and the lenders.
Dr. Hackbart has a question.
What's the typical reference rate that's used in these? Is it a standard reference rate, or does that vary by the particular circumstance?
Yeah, so reference rate, I mean, we're typically using SOFR. So back to the point about it being floating, most of this being floating rate loans, it's going to be like a certain spread over SOFR, as your risk-free kind of reference rate.
So we have in fact, we'll get to return forecasts / expectations for the various components of a private credit portfolio. So you'll see some of that and what what the result is in terms of expected outcomes.
When I look at the monthly performance reports that we get, I don't see that additional return for specialty credit above public equity, for instance. We've got a 6% long-term return on specialty credit where public equity has a 10%. Now, it does exceed the core fixed income, but that's more of a function of current interest rates. So I'm a little confused about where those compensating returns show up.
Well, and remember, this is debt. This is not equity. So we would compare more akin private equity to public equity, and our specialty credit, as Wilshire started with, has been a combination of public high yield leveraged loans and private credit. So it's a combination. So when we compare the opportunity sets, typically for this asset class, it's within that overall allocation. How does private credit stack up against currently the expectations for performance in public high yield and in leveraged loan markets? That's kind of the comparison.
The other thing we have to consider there is the environment we've been in over the past 15 years versus the environment that we're in going forward.
Yeah, certainly, as we've talked about on a number of occasions, in that ZIRP world, so in the zero interest rate world, which we lived through for so long, any asset class that especially had a more significant yield component to it, core fixed income, high yield, tended to have more muted returns, certainly than we saw in the public equity space.
But I think it could be noted, I mean, if you look at the 3 years, just the trailing 3-year returns that just come out, right? You have, the high yield, our special credit has outperformed public equity, right? Because it's been kind of 21 and 22 just kind of offset each other a lot. So it can be more, but you wouldn't compare it to that normally. That's not necessarily what you'd expect.
Might be helpful to take a look at kind of page 12 that shows, the differentiated return potential versus public credit versus private credit. So you can see, kind of what that looks like over 3, 5, and 10 years. I think it might be helpful to move back to page 8 and kind of just talk about what private credit looks like. And this is kind of just piggybacking off the conversation of kind of debt versus equity. So the graphic that we have on the right is the capital structure. Top of the capital structure is senior secured debt. Bottom of the capital structure is equity. As you move down the capital structure, your risk increases. So senior secured debt is the safest place to be. Equity is the riskiest place to be. So apart from equity, obviously, the senior secured debt, unsecured debt, and mezz debt, those are all functions of credit, or all part of credit. Mezzanine is the riskiest part of, kind of debt within the capital stack. Senior secured is the most. We'll get to this in a little bit, but kind of the different buckets that we think about when constructing like a diversified private credit portfolio. We're typically thinking 50% direct lending, 30% opportunistic, 20% distressed. So within direct lending, most of the time direct lending refers to strategies that primarily focus on senior secured debt. So that's kind of the safest place to be. And then as you kind of increase towards distressed and opportunistic, you might have some equity in there as well, or equity upside.
Dr. Hackbart has his hand up.
Is there any type of a rating service that rates this private credit in terms of its risk and so forth, just like the capital markets?
So typically,
and so forth. Do any of those firms rate any of this kind of security?
not usually. The reason for that is these businesses.
There's no third-party evaluation. How do we get our information then?
So I guess when maybe I'm not understanding your question correctly, so definitely jump in if I'm not. I'm thinking that you're meaning, is this like rated in terms of like a credit rating by a credit agency? Is that what you're referring to, or are you just talking?
Yes. Is there anything of that nature to give us additional confidence in the relative security of these particular investments in terms of their risk consideration?
Absolutely, yeah, it's a good question. So there's not a rating agency that really rates these businesses. These are small to medium-sized businesses. They're usually too small to really be rated. And a lot of these businesses choose to not be rated because it's expensive to go to a rating agency and say, please rate me so I can have, a rating. And because of the size, these rating agencies would typically assign them a rating that is maybe probably less than what they want due to their size. So private lenders look at this business and say, hey, what's actually more important to us than just the size of the business and determining what the actual credit risk is really understanding the operations of the business. So yes, it's a small business. The rating agency, if they chose to be rated, they probably would not get a super favorable rating. But we feel like, how this business operates is more important than just the sheer size of it.
And I think, also just to point out, keep in mind, this asset class, this type of investment has a role, and it is in the appropriate place in the portfolio for that role. So this is, again, not like the investment grade fixed income where all those securities are rated, we're investment grade and below investment grade and all those things. This is in a different place in the portfolio where the intention is to capture the return opportunity out of this investment landscape, but at the appropriate amount in your asset allocation policy.
Yep, this is riskier than investment grade credit for sure. So there's no doubt about that. But private lenders, because they're able to kind of really spend their resources on understanding the business and how it operates, they feel like they have a better understanding and can make better decisions than just looking at what a credit rating agency gave a company.
So to tie this back to some of the asset allocation conversations we've had, where in the KPPA bucket, we have the equity, the fixed income, and the inflation sensitive bucketing. When we look at the Wilshire bucketing, if we go back to those presentations, there were side-by-side comparisons on 2 different pages. So you actually see that Wilshire looks at private credit as a defensive growth bucketing approach. So this is going to have a certain amount of growth factor to it. It's not going to be that ballast to the portfolio that your investment grade or your cash is going to be. That's your defensive, your liquidity. This is kind of a step up from that, a little bit more octane in that fixed income kind of arena from the KPPA bucketing.
Mr. Cheatham has a raised hand.
I think it'd be helpful to the discussion to put it in terms of default rate. What do you expect to see the default rate within this market?
It's a good question. It really, really varies, honestly. It's kind of, there's not really a solid projected one that we could say, you know, for all of private credit, this is kind of what we're expecting.
And
Part of the more important discussion too, especially when in this asset class, is not just it's loss given default, not just default. Obviously, default impacts you know how the recovery has to occur, but I think Wilshire's done a good job of explaining here when we talk about these are backed, most of the, and specifically talking here in the lending, right? We know specialty credit and private credit's a lot broader than specifically the lending platforms that we're talking about here. But you know, that LTV that we discussed and being backed by typically assets, cash flows that are significantly haircutted, really mitigate that loss experience in the case of defaults. We do have platforms and current managers that have zero defaults across their platform. Now, you know, we do oftentimes there'll be workout situations, you know, and there is a number of different avenues that they have as private lenders to pursue in the event that a business has interruptions or experience. We saw it during COVID, right? That there were a number of restructurings that go on. Typically what they are able to do is tighten covenants, tighten restrictions, and increase yield on the loans that they're able to recast. But I think it's a difficult, there's not really much, unlike Moody's, where we see, you know, what's the expectation for the high yield market for defaults over, you know, the next couple of years. You don't typically see that in this market. And again, I think most of the focus is more appropriately on what is the loss experience in the event of a loan goes into distress.
yeah, I'll add to that, Steve. In some ways, you know, this is sort of a deeper due diligence process in a sense. If you think about high yield markets, everybody focuses on there's a level of defaults over time, and it's in aggregate across the entire market. Maybe many positions in there that you're not even invested in, but you think about that as sort of your risk of loss. In private credit, it's about the manager. So it's the due diligence process. When we go through that due diligence process, that whole process is focused on all these things Maddie has talked about, and a big component of that is, has this manager had any losses? All that comes into consideration. It's manager by manager.
I'm sitting here looking at some default rate numbers. Again, I think might be, you know, how exact they are, and I can send it to you from the standpoint of figuring it, you know, looking at the source of it. But for example, 2009, you know, what I'm looking at is broken down based on size of company that's been borrowing the money. And I'm looking at default rates in 2009 of between 10 and 12%. And then I'm looking at default rates in Q2 of 2020 of default rates ranging between 5.3 to 9.2%. And then I'm looking at Q2 of 2023 default rates of about, well, all of them are less than 3%. Does that seem right to you guys?
I mean, if that's the data, but I think what we're trying to convey is that, you know, just because there's a default doesn't necessarily mean that that's your loss. You know.
Oh, I understand that. But I'm looking at it from the discussion of risk. But yes, yeah, you're absolutely right. Just because it's a default doesn't mean you're not going to recoup something, if not all.
Covenant defaults. It's not a financial thing necessarily, right? Well, I mean, just kind of like speaking broadly, can't help but notice, but you talked about kind of a GFC forward there. I think looking at the change in the lending environment through that time, going from what was a lot of bank loans back then to moving into private credit, where private credit is really, while they don't have these quote unquote regulations around them, the covenants and their due diligence, to Maddie's point earlier, where a bank doesn't necessarily have the expertise and the speciality to dig into the actual business itself to underwrite the loan. I think you're getting a lot of these private credit firms that do have that speciality, and they're able to do a little bit more of that due diligence. So from a macro trend, seeing that go down, that's not necessarily surprising to me.
Yeah, and I'll add to that. So I'm not sure if those default rates that you quoted are, they are likely some kind of aggregate measure. And so if that is just in the private credit markets, or maybe a component of that, say direct lending, it's probably across a basket of many, many exposures, many managers, et cetera, in a broad sense. I'm just going to assume it is without having looked at it.
And just because it was a quote unquote default, I think, that's a contractual covenant breach right there. That does not translate to loss right away. So I think that's a key distinction here.
Yeah, I think we talked about loss. I mean, that's such a significant component of the due diligence in private credit on the managers. What is the loss experience? And in every one of these meetings, that's an extensive amount of conversation.
Dr. Hackbart has a raised hand.
I guess I was curious about the fact that if I understood what you're saying, is that you're assuming that the private credit firms are capable of doing better due diligence than banks, which are subject to regulation, which seem to put more pressure on them to do more effective due diligence than private credit firms, which are not subject to regulation.
Yeah, totally wrong.
I think the private credit firms are specialized in this due diligence, and I would think the banks would actually say that they do a better job of the due diligence than the banks are capable of doing. And again, part of that is scale, right? I mean, we talk. I think Wilshire mentioned these tend to be. I mean, we used to consider this like the middle market, right? And so now it's small to middle. So the sizes of the loans and the businesses they're lending to typically fall off the radar of especially the larger banks, right? This is not their wheelhouse. This is not where they spend a lot of time. And if we talking to specifically the managers that we have, I mean, this is part of what, the differentiator is their ability to do this work, the database that they have for companies. A lot of times, as we've seen in prior presentations, same companies come back to market multiple times, right? I mean, they're repeat borrowers. They're not single borrowers, and then they're never in the market again. So having a history on the company, the management, the operations that's a real differentiator in this space.
Yeah, banks tend to have a defined credit box. So if it doesn't fit these certain parameters, they just punt it, like Wilshire said. Like they don't have time for that. Their job is their inventory, their whole reason for being is to make loans. And so if it's too hard, it's too hard. They have other things to do. It's not a great use of their time. Whereas for private credit folks, that is their business. And so, many of our managers, the top franchisors for restaurants, like our manager works with, yes, they can get bank debt and and that's often the exit. They get refinanced by a bank at, very low rates. But if they're doing something that's just a little bit outside the box, whether it's, buying their neighboring franchisee or, doing some transaction because of taxes or something else, that's out of the credit box. So the bank's just going to, throw their hands up and go away. And so our private credit manager is going to get paid a little bit more for their capital and for being there and for doing the work. And that's the value they're bringing to it.
Part of why we like this market is that there's just so many companies, kind of that need capital. And so banks aren't motivated to, have to make it work with one company that doesn't fit their credit box. There's plenty more to choose from. So private lenders are kind of, picking up what banks said, not even necessarily what banks said no to, because the bank may not have, been able to kind of provide the service that the private lender was going to anyway. But private lenders are able to absorb that demand that banks don't want. I think it might be helpful to maybe turn to page 10 and maybe talk a little bit more about just like kind of the different buckets within private credit. So this is kind of how we break down the private credit universe. It's a simplified version, but this is kind of showing, what we typically like to think about when structuring a diversified portfolio. About 50% kind of this specialized direct lending, 30% opportunistic, and 20% kind of distressed and special sits. So, maybe just to start with kind of specialized direct lending. Like I said previously, direct lending typically refers to kind of that senior secured lending, the safest place to be in the capital structure. They may do some junior debt to a limited extent, but really you're thinking like over 90% kind of this first lien exposure. You may hear kind of like specialist versus generalist direct lending. All we mean by that is generalist focus on maybe usually sponsored and non-sponsored, any industry, any sector, they're just kind of generalists looking out for the best credit out there. What we mean by specialist direct lending is managers that maybe focus in a specific industry or sector. So two of the most common ones that you'll typically see are maybe like healthcare or tech. Those are really common kind of specialist direct lending strategies, just given the tailwinds that those sectors have been facing. So I just wanted to kind of point out that piece of differentiation. Also, I would point out, you're going to hear sponsored versus non-sponsored. Sponsored basically means that these private lenders are lending to businesses that are owned by a private equity sponsor. Non-sponsored direct lending is private lenders lending to businesses that are not owned by a private equity firm. Typically, what we mean by not owned by a private equity firm, it's a lot of like founder-run businesses, like family businesses, kind of owner-operated, not a private equity firm. So just to kind of add some detail there, we're pretty interested in the non-sponsored space. It's a lot less efficient. And there's also kind of some data that shows there's a little bit, you're kind of getting better pricing with working with these non-sponsored folks versus sponsored. As you can see, also kind of like the lowest returning, but still, definitely a growth asset. Maybe moving on to opportunistic, includes kind of specialized asset-based lending, as well as, which kind of includes, a line of credit may be secured by inventory, accounts receivable, equipment, or property owned by the borrower. So this kind of goes back to our kind of collateral that we were talking about with these kind of ABL strategies. And then also kind of distressed in special situations. So, this includes distress for control, distress non-control, distress trading. So one example of kind of a strategy that would fit into this is, distressed in special situations category is a company in bankruptcy or facing bankruptcy. A lender will lend money to that business, usually in like the senior secured position, because they're the first priority of claim when that business actually does go through a bankruptcy. They're the first priority of claim. And they receive, the value and actually become the equity owner and actually do the workout, kind of reorganize the business to make it more efficient and then sell it off, similar to how a private equity manager would do it.
If we are a pension system that is less than 60% funded, why would we be interested in investing in distressed debt?
It's a good question. Like I said, baseline is kind of like 20% distressed exposure. However, based on, certain risk tolerances, you can certainly reduce that a little bit. But I think our bigger point to why we feel this is a part of a diversified portfolio is that typically when direct lending is doing well, distress managers aren't doing as well. When the economy is in distress, these distress managers are going to do very well, and like direct lending, is pretty defensive overall, but might not do as well. So it's less about, we don't like to time the market. We want you to be, have these different exposures and have a fully diversified portfolio. So no matter what the market's doing, you're well positioned.
You mentioned earlier about the collateralization, would only the first category involve assets or loans that are being collateralized, or obviously probably not distressed? They probably wouldn't be decollateralized, or are they?
So opportunistic is usually the category where you're going to see asset-based lending, where the collateral is some type of asset that's being pledged, like a piece of equipment, or I know I gave some other examples too. But With direct lending, it's instead of usually a piece of equipment, it's usually like the cash flows that are pledged as collateral. A lot of direct lending strategies focus on businesses that have highly recurring revenue. So there is usually like a component of like a stable revenue stream to pledge as collateral. And I think it might make sense, if we kind of turn to page 11 and we can take a look at, where these strategies kind of stack up on the risk return spectrum. This might give you just kind of a good visual of the private credit universe and kind of where things land. So as you can see, highest kind of risk return is distressed versus also some venture debt. We don't really do venture debt because it's really, the risk is higher than the return that you're actually getting. Where we do distressed and special sits, you're getting a better trade-off for that. As well as opportunistic and kind of specialized direct lending, you can see they're kind of positioned at an attractive point on this kind of risk return spectrum. I know we already hit on page 12, but maybe it might make sense to go to page 13 and kind of just talk about how private credit is performed versus public credit in difficult times. So, as you can see here, we look at 2008, COVID, first quarter of 2020, and then first half of 2022, which was the U.S. Federal funds rate hikes. So as you can see, private credit has performed kind of better than public credit. Moving on to slide 14, you can actually invest in private credit using a variety of fund structures that kind of have various benefits and limitations. The most common way for LPs such as yourself to invest in private credit is through a closed-end fund. This is the typical structure for most private funds. They usually have a high minimum investment, typically 5 million, maybe over, and then they're also illiquid in structure. So these are fund structures with anywhere from like 4 at the absolute kind of smallest to 10-year life. So not quite as long of a life as private equity, but still very much illiquid. Diversification is lower. You're exposed to kind of one manager and like one strategy. However, the underlying credits within that portfolio is kind of, it varies manager by manager. So if diversification is something that you're valuing, you can certainly select a manager that just holds more kind of underlying credits that is more diversified from that perspective. There's also a large opportunity set. The manager doesn't need to worry about liquidity as much, so they have a lot more options in terms of what they can invest in and make the selection less about liquidity and more about what's going to earn the best return. And pricing is conducted typically quarterly, but sometimes less, but quarterly is pretty much the standard. And low access by individuals. These structures are very much meant for institutional investors, not individual investors. Fund of funds is another method. The benefit relative to kind of these closed-end vehicles is that you aren't exposed to just one manager with just one strategy. You're exposed to kind of like multiple managers, multiple strategies, and therefore more underlying credits. So you're more diversified by manager and then also by number of credits. So that improves your diversification. The opportunity set is a little bit smaller than kind of closed-end funds because fund-to-fund manager is picking other managers to allocate to, so there's a smaller universe. And a limitation is that expenses tend to be a bit higher for that diversification. Public ways to access private credit includes mutual funds and BDCs, or business development companies. These are generally better for individual investors versus institutional. Just because individuals may utilize them if they're looking to institutional investors may utilize them if they're looking to allocate kind of smaller amounts, so you don't have to deal with this like higher investment minimum that's usually like 5 million, sometimes even more. So that's why individuals like it, and also if an institution wants to make a pretty small commitment, those can be useful. You also have better liquidity because the manager doesn't have to worry about because they are worried about liquidity, the opportunity set is a little bit smaller, which is kind of less ideal. And on page 15, we've talked a lot about the benefits of private credit, but private credit manager selection is extremely important. On the left side of the page, you can see manager selection in the public markets versus on the right side of the page, you can see, kind of this dispersion of performance for private markets with private credit kind of in the middle of this red dotted line. So you can see that there's an 8.2% difference between top quartile performers and bottom quartile performers in private credit. So that's a huge difference. Very, very important to select manager as well. And page 15, private credit is complex, and so there's a few different considerations, when investing in private credit. Most importantly, and I think we talked about this today, is the lack of liquidity. This is an illiquid asset class. There's also a long-term horizon. There's also investment risks, which I know we've talked about as well, such as credit risk. It's a huge one to consider. Valuation changes, this is not mark to market every single day. It's similar to private equity. There is some valuation risk there where it's marked on a quarterly basis. Also alignment to return profile. As we discussed, distressed, you're going to get higher returns than in direct lending. However, the risk is kind of proportional to that, as well as suitability.
Dr. Hagbart has a raised hand.
Could you talk a little bit about that you've got the charts about the performance? Who actually does the calculation of performance? Is there standards there, or are these just offered by the managers themselves? Is there any kind of a industry of continually evaluating performance by these managers? Where does the data come from?
So it's a couple different sources. Wilshire has its own database for public markets where we actually have investment managers providing us returns, and we can develop these peer groups for things like global equity, global fixed income. When you move into the private markets or hedge fund arena, there are specialty databases for that. So in this case, I believe the private credit data is coming from a company called Preqin.
So that's a continuous flow of information that's available to you. Is that the idea?
They specialize in private equity, private credit, these private kind of arenas or asset classes, if you will, to collect, aggregate that data, and then be able to build these peer groups.
Okay. Good. So it's sort of a national source, but it's a private source. Is that the idea?
That's correct.
And that's a broad collection of data, across a large aggregate group of managers. But I think, to Maddie's point, those on that page that we still have up, the dispersion of returns, like any of the private asset classes relative to public markets, the dispersion of returns is greater, meaning that due diligence is just extra important, because identifying the best providers in these areas can lead to outsized returns.
We also have included a private credit glossary kind of in the back. So I won't go over this, but we just included it for your reference. There's a lot of lingo that goes in with private credit. So if you're ever, if you hear the terms Cov-Lite and you want to go back and make sure that you understand what it is, we've just included this here for your reference. So happy to take any more questions before we conclude.
Okay,
Great.
Okay. All right. Do we need to take a break for any reason, or should we just move right into the rebalancing? Yep, Rob?
Let's take about a 5-minute break, please.
Okay. There you go.
Let's be back at well, let's make it 11:10.
Okay.
Thank you, Phil. All right, Wilshire, back to you.
Hey, thank you very much. So we are going to move on to the next section, which is talking about rebalancing ranges. Again, this kind of ties back to the last IC meeting where we presented an asset allocation, a couple different alternative allocations, strategic allocations that you may move to. But the board also needs to help set what the ranges around those asset allocation targets are going to be. So this is work we've already started having conversations with staff about, but just to give you as a means of background how important it is to have these ranges set. If we move to slide 24, you'll see that it's really important to keep the actual allocation close to long-term target policies. And the reason for that is if you go through whether it's a period of market stress or market growth, you could end up in situations where you have meaningfully different risk profiles within a portfolio. If you have a large equity sell-off, you could be significantly public equities, or on the flip side of that, if you had a year like last year, 2023, where equities were up over 20%, you could potentially move above your top end of the portfolio as well. So the nice part about having a rebalancing strategy around that, you have minimum and maximums around your targets, and those don't have to be symmetrical around the target. They can be asymmetrical, but it really kind of forces you, if you think about, let's just take equities for a second, if you do have an equity market sell-off and you move below that minimum range, it forces you to be a buyer at lower depressed prices. Where on the top end of the range, if you move too far or you go above that maximum threshold, it's forcing you to be a seller of equities at higher prices. So it keeps you kind of within these nice ranges, and it really kind of takes the behavioral bias out of letting your winners win, or just the behavioral finance that can kind of take over. So that's why it's nice to have a nice kind of documented rebalancing policy that staff can adhere by.
How often should we change our asset allocations?
So when we work with clients, we generally tend to say that we should go through a full asset liability study every 3 to 5 years, unless market conditions warrant a revisit of the actual asset allocation. So it's been just over, I want to say 3 years since we did the last one. It was
Right.
Third quarter of 2020. So we presented in fourth quarter of 2023.
That was before the split.
That was before the split, correct. So we're kind of right in the early part of that cycle of 3 to 5 years.
And we just presented that in
November.
November in your November investment committee, which is still an outstanding item for you. But yeah,
Right.
So that's the second.
Yeah, the asset allocation was November of 21.
Oh, I thought it was 22.
That was an asset only. The last asset liability study, I believe, was in 20.
It was fall. Yeah,
That's correct.
fall of 2020. Yeah.
Correct. So when we do an asset liability study, we're actually working with your actuary, pulling all that information, and then that goes into the asset allocation process. We do review your asset allocation from what we call an asset-only perspective, because Wilshire does produce capital market assumptions. We used to do it year over year, but we've moved to even a quarterly update of just the return assumptions. So our investment research team has taken our models, all of the current macroeconomic data, feeding it into those models, and we actually can see how our assumptions are being impacted by the last quarter's market cycle.
And those are, we always talk about this when we present that work, but those are still 10-year forward-looking capital market assumptions, but they can move a bit quarter by quarter.
Yeah.
Particularly in the last few years.
So when we look at the rebalancing range and the considerations there, you can have ranges around these asset classes that also allow for tactical views, that staff can have discretion to take overweight, underweight, different pieces of the portfolio. But really what you can think of these are the guardrails also. So you're allowing them discretion to be able to say we want to be a little bit more in a risk on or risk off position, overweighting, let's say, equities versus fixed income, or vice versa. constantly reallocating to target is not possible. So when you think about if we were in a completely frictionless environment, there were no fees to rebalance, and we should be rebalancing on a day-to-day basis because we set our strategical tactical asset allocation. The reality is there's costs associated with trading. And Wilshire has models where we can evaluate different rebalancing strategies on an ex post basis, but most clients tend to go with this range rebalancing, setting the minimums and maximums, and then it really comes back to does the staff want to rebalance all the way back to target, or do they want to just bring the range kind of back in maybe 50% of the way back to target, so you still have maybe a tactical overweight to equities if you hit the maximum on the upside there. One piece to consider here is that illiquid asset classes, private credit, for example, which we just got finished talking about, or private equity, those aren't levers that staff can pull on to rebalance a portfolio. When you've committed that money, you really can't change that allocation, and you're going to get hit with the denominator effect, or as market values increase or decrease, that percentage allocation to those alternative asset classes is going to move up or down. And if you go outside those ranges, you technically don't have the ability always to rebalance back into it without going to something to like a secondary market where you may have to sell positions, 80 cents on the dollar type thing, and take a loss to bring those back in, which we technically don't want to do. So a lot of the ways you can go about doing that is take private equity, for example. If you were overweight to private equity because we went through some type of a market or an economic stressed environment where the overall denominator came down, the plan asset value came down, you can actually kind of control. One of the levers that staff can pull on is they can underweight public equities as opposed to private equity. So you're still keeping that overall growth exposure within some type of boundaries there.
And there's been a lot of cases of that. You've read a lot and heard a lot about the denominator effect, and many funds have gone overweight their private equity allocations. And so that is, as one example, other private asset classes as well. But that, the idea of also putting those rebalancing ranges around the broader bucket can help you keep the risk profile of the fund more in line with what your intended targets were. Even if you have tactical opportunity within there, you can still try to keep the buckets working together. So things like underweighting public equity, if that's what you need to do to offset that private equity overweight, or vice versa.
When we think about the rebalancing range sizing on slide 26, as you might expect, each asset class is going to have its own different risk levels. Equity is more volatile than fixed income, generally speaking. So when you look at the equity range rebalancing, you're likely going to have wider bands on the equity allocation than you are on the fixed income allocation. That's just due to the underlying risk nature of those asset classes. More volatile asset classes are going to have those wider range, and then safety assets are going to be a little tighter. So something like your specialty credit, which sits in between equity and the kind of the liquidity or the public investment grade core fixed income, is probably going to sit in between those two asset ranges.
And Chris, one thing that we have talked about that's probably a good point to make in this session is, we specifically for that, like the core fixed income, if we both think about the volatility of an asset class, the risk of an asset class, as well as what we would be willing to position from a risk perspective in an allowable range. And Chris, you mentioned the asymmetry potentially between asset classes. And specifically for core, we think of core as kind of one of our key ballast in the overall risk profile of a portfolio. So certainly having maybe a tighter downside, we don't want to fall below a certain amount because that can materially alter the overall risk profile of the portfolio. But this would be one where we could argue for maybe a higher upside. If we wanted to de-risk the overall portfolio, we have limited areas where we really are, the safety assets, if we'll say that, I'll use air quotes there, cash and core, right? If we wanted to de-risk a portfolio, if we thought we were entering extremely uncertain times, or there was a risk of a significant drawdown, where would we be putting money, allocating away from and allocating into to de-risk the portfolio? So that could argue from potentially core being a tighter downside and higher upside, because that's a safety asset where we may allocate in times of stress.
Absolutely agree with you, Steve. And another thing, when you think about these rebalancing ranges as well, we're talking about risk profiles. The other thing that can actually change is the liquidity profile as well. So part of the reason to have these rebalancing ranges in place, and it doesn't have to be always just at the asset class level. We can build in, because some of your buckets do have other moving pieces in there, we can build general relationships or rebalancing ranges within those as well where possible, to try to make sure that we're getting the right liquidity or growth factor exposure, inflation factor exposure, whatever that might be. We can all build that into the rebalancing ranges, so that really ultimately what this is, they're guidelines for staff to manage the portfolio, but they're guardrails to make sure that the adopted portfolio that the board ultimately chooses on for your strategic asset allocation, that you're not deviating widely from that. Are there any questions on rebalancing? And I will say one other thing, because we are going to get ready to move on into the governance section. This should certainly be spelled out in your investment policy statement.
Yeah, ties right into it. Okay, should we move on to fund governance? Sounds like it. Okay. So this is an area, it's good to review this from time to time, and one of the things that we'll often do in a review of fund governance is then just come out of a session like this, an education session where we talked about these different issues, and then think about how can we say, visit those sort of one at a time as we go through the next year or something like that, just address those very issues. So it's often a good time to go through this educationally, and then have a follow-up session or a number of follow-up sessions throughout, some near-term period of time to just touch on how are we doing each of these, how have we thought about, do we need to make any revisions there, et cetera. But just some of the general rules for institutional investors, and some of this is even just, this like trustee education. So where should trustees' attention be focused? And it is on, we believe it's on the decisions that matter the most. And those are the high-level decisions of asset allocation setting, investment policy statement, et cetera. We'll touch on that some more on the next page, but all of those decisions are really where a board and investment committee should spend a lot of their time. A lot of that implementation can be time spent by the staff and how they're implementing the board and investment committee's decisions. So important to stay focused up there, but some things to think about. Time horizon is important. Certainly, just as Chris was talking about rebalancing and the buy low, sell high opportunity, that little bit of rebalancing over a long time horizon, if you're focused on that, you can capture a lot of gains and compound a lot of asset value that way. So time horizon is important. It's also important when we look at the capital market assumptions and we do the asset allocation reviews or an asset liability study, where we're always talking about these are 10-year forward-looking assumptions. Keep that in mind. From our perspective, we think it's very difficult to try to forecast returns for any period that's much shorter, say a 3-year or 5-year kind of period. So time horizons are important. And again, even at that high level, and the point about controlling risk through diversification, I think many asset owners can be, as a very broad statement, can be sort of misled to think that they're really well diversified when all they've really done is diversified capital, but maybe haven't diversified risk. And so we talk about that in all the asset liability work we do with you. We talk about that. And we actually calculate what's driving the risk of the fund. Aside from its allocation, what's actually driving it. And growth assets, higher volatility, equity-like assets, drive any investment program's volatility more than anything else. And so it's just important to understand those drivers. And also the factor exposures. We just went through this quite a bit in November with the bubble charts and showing the economic regimes of rising and falling inflation, rising and falling growth, and just looking at those, not just having a diversification done in a way that diversifies your capital, and also not just focusing on what's the expected volatility, but how are you positioned for different economic regimes that you'll go through. If we're going to go through a rising inflationary environment, how are you positioned for that? Do you have assets that help to hedge in that kind of environment, or a falling growth environment? So that's all kind of big picture stuff that's important for trustees to be focused on. And also, as you review fund performance over time, connecting those dots. So we'll touch on this a little bit more in the next page, but just connecting, what are we trying to accomplish? What are our goals? And then every time you review performance or a particular investment, be thinking about how does that tie to the big picture of what we're trying to accomplish.
And I think that last bullet point there is something also to be kind of touched on. I know it gets brought up a lot of times when we're talking about some of the alternative asset classes, which clearly do have higher fees. And as we went through today, some of the performance expectations for those are quite a bit larger as well. Part of that is for the additional risk or the liquidity that's added onto that. It is very important to monitor fees, but you also can look at offsetting in areas where you're taking a passive investment in equity markets or core fixed income where it's lower fees, and be able to really kind of take your fee dollars and spend them in areas where you have that more upside potential in some of these other illiquid asset classes.
Yes, exactly, right. Yeah, there are times and places for higher fees in a portfolio, and there are times and places for significantly low fees in a portfolio. So it matters, investment by investment, matters by asset class. Even things like, recognizing that past performance may not be the best indicator of what's going to happen going forward. And I think about often with just reviewing managers that you've selected for the portfolio, and you have a manager that has underperformed over the last 3 or 5 years, for example. That may not be a reason to terminate that manager. It may be that their style has been out of favor, their approach is still very solid, it's highly, at least from our research perspective, a high score on that strategy. But every manager, at least in the public markets, every manager goes through cycles. And if you've had a chance to look at our paper that we put out around the spring of every year, it's an active management review, and it will show real clearly how managers, even from a ranking perspective in the public markets, they'll move around. If they've been top quartile for the last 3 years, their probability of being third or fourth quartile in the next 3 years is greater than 50%. In most cases, when you look at the data. So we look at that across all asset classes. So it's just a reminder that when you're kind of down in the weeds of the portfolio, and again, we think committees and boards should be high level, but when you're looking at individual components like that, keep in mind that there's a lot to that, and a lot more than just how a manager has done over the past few years.
I think that goes back to the chart that we had up earlier where Dr. Hackberg was asking about where the data came from, and we had the distribution. Equity markets were a little bit more compressed, but that median number was pretty much in the center there, right? So you're going to have kind of like 50% winners, 50% losers. But when you move into some of these alternative asset classes, that's where you're going to see it's very, very important to pick the best managers, because those are the managers that really kind of get you that return premium that we're looking for.
And even the point about market timing, and this ties right into what Chris just went through with rebalancing. This isn't to say that market timing doesn't ever work. The point of this statement is just recognize, if you want to be tactical with your assets, the starting point is a tough position. It's statistically difficult to time the assets at a high level in both putting positions on and then when to take positions off. So many asset owners, maybe many asset managers, et cetera, across the industry for decades have worked hard at this, and some win from time to time and a lot lose from time to time. So doesn't mean don't ever do it, but what it does mean, I think we'll talk about it more in the next page, is be intentional about what you want to do in the way of being tactical, and then just manage that and follow that and track it and make sure you're accomplishing what you want to try to accomplish with that process. So if we go over to slide 29, this, just the general framework, this chart shows up so often in work that we do because it continues to be true that those decisions at the top of that chart have the biggest impact on everything. And so we think about very much for any investment program, it's a top-down process where you're setting those objectives at the top, you're establishing the asset allocation policy, the investment policy statement, all that is at the top, and that is where committees and boards should spend most of their time. And then as you step down through that, you have asset class by asset class structure that we talk about with staff when you're implementing and building asset class structure. All of the decisions you make as you go down through this process, from setting asset allocation policy to building the structure of an asset class, deciding what its profile should look like, selecting the managers that will manage within there, all of those decisions should flow back up to the top. What are you trying to accomplish? In fact, you can think of, in some ways, about this like a mission statement. When organizations set a mission statement, they will often make sure that every decision they make somehow circles back, loops back to that mission statement. You can think about that with the asset allocation policy and process, and when you're building that, everything should tie back to that. So for example, in the asset allocation policy, you've set a level of intended risk, and then we talk about those rebalancing ranges. With rebalancing ranges, you should be able to think about, if we are just strategic with those and we have, say, very tight ranges, how much risk does that introduce? How much can that cause us to deviate from our intention? If we want to be tactical, how tactical do we want to be? How much risk do we want to take in that with that decision? So the point about this is you can be anywhere on the spectrum of making those decisions and how much risk you want to take. What's important is to be intentional about it and make a decision based on what you expect the outcome of that risk to deliver for you, and then to monitor that. So
Dr. Hackbart has a hand up.
Yes, could you talk a little bit about the definition of asset classes? It seems to me so far our asset class definitions, we've changed it over time slightly. How do you evaluate our current asset classes? Or should we be more definitive? For example, if I understand correctly, private credit includes could be called fixed income to some extent as well. And how do you differentiate among types of investments into asset classes? Is there something there that we ought to look at?
Well, a very general statement is that asset classes reflect within them similar approaches to investing. So if it's equity, what type of equity is it? Is it public equity?
Some are obvious, but some also seem to be a little bit unclear.
Right. Yep. Well, so, and to your point about, I think about the private credit comment, we had said at the outset of that piece that private credit and public credit are two different forms of credit. So I think maybe where you're going, Dr. Hackbart, the only place where there's sort of a combination of that is in your terminology of specialty credit. And that just means that it includes both the public credit and the private credit components. So they are different. And as long as you know the differences between those, and then make decisions about how much of that you want to be in public credit, how much of you want it to be in private credit, it doesn't hurt to have it rolled together in a component called specialty credit. But generally speaking, your asset classes are, appropriately reflective of what you're trying to do. You have real return assets, you have real estate, you have public and private equities, and public and private credits.
To put maybe even a finer point on that, and we've seen this from other institutions, generally you want asset classes to have differentiating correlations amongst each other. So
Right.
the way I kind of look at that is if you were to look at the equity market, there's a reason we don't break out large versus small or growth versus value. Those are going to be very highly correlated to assets. So they kind of go into the asset class together. Whereas, the obvious one is stocks versus bonds. You think that there's going to be, that differentiation between those two asset classes. So I would kind of look at your asset allocation, and I would say you have an appropriate number of asset classes. Bucketing the public and the private credit into the specialty credit is certainly fine because they do have similar return and risk profiles. They're not exact, but they're similar. And I wouldn't want to see you have 30 different asset classes because at that point, I think you're kind of breaking things out into too fine of a detail, and it's going to make any optimization or selection between those asset classes very, very dependent upon the inputs that go in.
Yeah, that's.
I guess in that regard, for example, I think we merged domestic and international maybe a year and a half ago. Is there any reason to reconsider whether or not we ought to differentiate?
I don't think so because you're still looking at public equity at that point.
Okay.
There are indexes out there that obviously look at global equity in total. And when I would look at a global equity composite, then the starting point would be that index, 60% US equity, 40% non-US, roughly speaking, in today's market cap weightings. But you don't have to split those out because ultimately when you split them out, then that means you probably have to put some type of constraints on the optimization to get roughly market weightings, unless you're going to take some tactical view against the market from a region exposure, whether that's US equity, developed markets, emerging markets, whatever that might be.
Right. Yeah. We have clients that, in terms of public equities, do it both ways. Many clients who carve out the U.S. and non-U.S. components, and many who put it all together, and it's global equity. So
I think the main reason we did that was that sometimes it's hard to differentiate in a global economy what's domestic, what's international, or what's global, and
Economic perspective.
and so forth. So
I'm fine with it being the way it is.
Yeah. I mean, I think it makes a lot of sense the way it is right now.
okay.
To David's point, we have clients that do it both ways. They break out U.S. versus developed markets versus emerging markets. So they might have 3 different equity components there.
yeah. But to take that a step further, and it's sort of on this slide 29, it's the second section where we talk about investment structure. Oh, that's where you have the opportunity to make sure you know how you want to be allocating. So for instance, Chris mentioned in global public equity, the US today makes up about 60 to, so I think it's maybe around 62% right now of world capital markets. So structurally, you should be thinking about if we're going to have global equity, then that's what global equity looks like as a starting point from a benchmark perspective. And if you want to be different than that, you should process that decision. Why do we want to be different? Do we think we can do better? In fact, there was a time here a few years back when you were overweight non-US equities relative to US equities with the expectation that you'd capture better performance based on where valuations were at the time. You can still argue for that today where valuations are today. So what's important is to be aware of what you've set and what your intention is. And if you want to look different than the market itself, you can, but make a proactive decision about that and then measure that and make sure that if you made a decision about that, that you're winning from that decision. You're being compensated for it, over time. And if you don't want to make a decision about that, then you structure it, like the global markets are structured. And then the same thing happens within U.S. equity, for example, when you get to size and style. Do you want to be style neutral? Do you want to not have a permanent expression to overweight value stocks or growth stocks? We think style neutral is a good way to go because we think the cyclicality of those style factors is really difficult to try to win with.
That hasn't exactly played out so well.
Nope, we have a long run going back to the credit crisis right now that makes that
growth has been
difficult.
an unprecedented run up.
Mr. Cheatham has a question.
You're muted.
Thanks, Sherry. You know, asset allocation, as we all know, is 90% of our return. Equities and fixed income, you know, they're pretty clear cut where they fall out in the asset allocation. Some of these assets that we're looking at seem like they could fall out in any number of different asset classes, whether it be public equity, private credit, real return, what have you. In looking at our definitions for these asset classes, do we need to tighten that up, or what seems to be a good way to categorize that so that we have a good rule of thumb as to where these assets are being placed in our asset allocation?
So I think, you know, a way to look at that would be to make sure the investment policy statement does have a tight description about what are the asset classes. And then if something does span across multiple asset classes like that, for example, a multi-sector type of investment that for whatever reason is one that you want to make, and if it spans across multiple asset classes, you should just be aware of that and be thinking about that as having you know, a component of equity and a component of fixed income, for example, if you invest in a product like that. So I think, you know, in those cases, I think, I mean, just to step back, you know, part of this top-down approach is every investment decision you make should be tying back to the structure of the asset class and then the asset allocation policy and what are our intentions around that. And so if you do that, when you look at any investment, generally those will be dedicated to a particular asset class. And in certain cases, if they aren't, if they span a few asset classes, that'd be part of the discussion about why does this have a role in the portfolio.
And that might be more of the exception.
Yeah.
I think most investments that staff are going to bring to you are probably going to fit nicely into one of the buckets that you have. It'll be pretty obvious where the investment should reside in your policy, but that should be part of how investments are brought to the table.
So just to take that, you know, a little bit further, you know, one of the things we've done in the past and can be revisiting, and Joe spent a lot of time in this in the public markets, looking at the structure of just a single asset class. Take, for example, U.S. equity within global equity and modeling that structure and choosing a level of active risk to have there. So if you think about every one of these areas where you can invest passively, that's starting point. And then from there, how much do you want to differ? And generally speaking, you know, we will be recommending you differ more in areas where markets are less efficient because there's more opportunity to outperform in those markets. So small cap stocks versus large cap, there's a difference there. Non-US equities versus US equities, there's a difference. Non-US markets are just less efficient.
And David, just to kind of put a point on what we call investment structure, that's very much a Wilshire term, I think. I want everybody to be clear what we're talking about. So if you look at an equity market, we're talking about how you allocate within that equity market. And it's not just, am I going to be US versus non-US? Am I going to be growth versus value, large versus small, active versus passive? So it's the overall structure of your composite that we're talking about there. So there's a lot of decisions that go into the investment structure, but back to David's point, you're probably going to want to tie that back to a lot of the investment beliefs that you have for that particular composite. You know, within US equity, one can argue large cap US equity is probably one of the most efficient marketplaces in the world. Is that an area we want to use an active risk budget or fee dollars in that area? Maybe, maybe not. Whereas when you go into something like fixed income or high yield, that's more of an inefficient marketplace. We're certainly going to want to employ active management to a higher degree in those areas.
But I think the point, you know, for the decision making at the high level is go through the process, and that's the whole, all of us working together, it's staff, it's us, it's the investment committee, just go through that process and decide where do you want to be in each of these areas and then establish that. And then going forward, monitor that. And that way, as you evaluate every investment you evaluate, you can look to see where does it have a role. Let's, say you've made a decision in non-US equity markets to have tracking error of 4%. That's just a measure of how different your results may be relative to the index, and you're doing that because you think you can outperform indexes with good active management. So if you have a decision about that, then just monitor that as you go forward and think about every investment that comes into the portfolio. Does it fit here? And maybe that's a much higher risk investment, but it may still have a role because it might be complemented by something else that's overall trying to achieve the profile, the intended profile of the asset class. So if you just think about these things from the top down, it can lead you to a point where you make clear decisions about each of these and then put that in the investment policy statement, state what that is, and then use that as your guide. And everything you're doing, try to tie back to that. And is it meeting our intention? And the same thing when you review performance.
I was just going to say that really goes to what Dave was just saying is really slide 30 there is all of these investment beliefs or guidelines, risk tolerances, whatever it might be, those should be all spelled out in your IPS. The IPS should be a living, breathing, working document that you're reviewing, and if you see that there is a hole or a blind spot or anything like that, that should be something that you feel like you can bring up in any of the IC or the board meetings so they can get addressed. Because that IPS statement really should be from an outsider looking in, whether it's a new board member or a new staff member, whoever it might be, they should be able to read that document, have a pretty good understanding of how you're running your fund, what the beliefs are, what the targets are, everything that, how do I go about operations and things like that. That should all kind of exist within that IPS.
Yeah. So I think any of these, just in the interest of time, we'll stop there on the slides, take any other questions, but any of these we can dig into further should you want to as we go forward this year and take off one or two of these and just spend time on it and drill down a little bit more on these. But it's I think the takeaway is from a committee and board standpoint, be high level and then monitor those decisions and make sure that you're achieving the kinds of things that you set out to achieve, what your intentions were. Any other questions about this piece, governance?
Dave?
Yes.
I'm a firm believer in trying to benchmark ourselves. I try to benchmark myself in my business.
Mm-hmm.
Are there, and can you help determine who they are, similar sized public pension entities out there that seem to have a good IPS, one that seems to work well, that also they've had good performance return wise, obviously, that you can recommend we take a look at what their IPSs are and compare it up to ours and see where we might be able to adjust ours?
We could certainly do that. I think, and so maybe that's a step in the process of revisiting the IPS. Keep in mind every IPS is suited to that particular asset owner. So there'll be differences like that. That would be different for any other fund. We look at a lot of IPSs. We work on IPSs for every client we have. So, we do a lot of work in that area. I think, a good follow-up from today's education as well as the investment policy decision that is, I think will be, perhaps voted on at your next investment committee and then board meeting. The timing of that is all perfect to then also go to the IPS and revisit it for all of these things we're talking about today. The IPS has had a lot of work done to them prior to the split, and then we've done some drafting in the last 2 years or so of the IPS for C since the split. So I think the bottom line is put all that together as good timing. When we go through an IPS review, we will start with, and as we've already done with yours, and we continue to try to refine that, but we will mark areas where we would suggest you could make improvements. And so that'll come with that process, but we'd also be happy to try to find some of those that are out in the public that would be a good example in sort of general terms.
Yeah, I mean, we could just start even internally within our public plans team and, talk to folks that are in that, call it greater than $1 billion, less than 50 billion, start looking over their IPS, and happy to kind of point you in that right direction.
Yep.
There's a number of good research pieces out there too on drafting best practices IPSs.
Yeah. Yep. So a few minutes, do we want to move over to this sector piece for a minute?
Dr. Hackbart has his hand raised.
Sure.
You're muted, Dr. Hackbart.
I think it would be beneficial in terms, again, of the asset allocation compared to our peers. I think sometimes you can draw intelligence from those types of comparisons, and it's a kind of a check on our own decision process. So that type of information, I think, can be helpful as well. In other words, given our asset allocation, how are we doing in that relative to similar states? I think would be valuable information to just periodically review and think about and see if there are some of our peers that are having different asset allocations and how they're performing compared to ourselves. I think that's always a good strategy, and it's a good monitor, I think, as well. So that type of information, I can be valuable to our committee.
Yep.
Wilshire does publish an annual paper, both at the city and county level as well as the state level, that contains some of that information. We kind of aggregate all of that, publish a paper on it just to kind of show what industry trends are. So we can certainly forward you the most recent published version of that document. I don't think they publish it until usually sometime around summertime.
So once a year.
Once a year, but we'll get you the copy of the most recent one so that we can.
I would say those comparisons can be limited too, though, right? Like you would compare my asset allocation personally with yours, right? We're gonna have different risk tolerances, goals.
Absolutely.
And that's gonna be the same for lots of different state plans, right? And different funding levels. I mean, yes, you can compare. Like people like to compare us to teachers and stuff, but very different funding levels, very different structures, and that's just in our own state. But there's, I think that can go down a difficult road.
Yeah, that's totally spot on, Anthony. Anytime that we present that information, we talk about it as simply being observable data, but it does not mean that you should look like that group in aggregate or anyone in that group. We stress that. I mean, if you think about when we get to that asset liability study, which we just went through here into the November meeting, that's asset allocation is designed for your liabilities. It's all in there. So it's interesting to observe and it can be helpful, but you do have to be careful with it.
Yeah, and I think some good information can come out of that if we look at industry trends, which we look at not just for pensions but other things, magnitudes can vary dramatically to Anthony's point, depending on specific needs of plans. But as we've been pointing out for months here, specifically specialty credit has been, we look across public plans, across consultant bases. I think the support for that asset class from an opportunity set is, pretty uniform. That type of information, I think, is useful to the trustees.
Well, and for example, I think in comparisons with other peers who have similar funding ratios would be interesting and useful information. We realize that there are many major differences across the spectrum, but there may be ideas buried in the data, buried in those trends, and buried in those asset allocation strategies that could be beneficial for us to question ourselves and so forth. So it generates ideas and thoughts more than necessarily saying we are absolutely going to compare with someone else, because it's hard to do that. I realize that, but there may be ideas which can evolve from those assessments and looking at other strategies.
And just
Sure, and that's part of we talk to our peers. We talk to other plans, both when we're doing references as well as I was talking to a Canadian pension plan last week, and what they're looking at, what they're interested in, where they see opportunities. I mean, I think that's all the mosaic of the market intelligence that we gather, but it's certainly useful for trustees to see that type of information as well.
And I would just say that any data set, to Anthony's point, you do have to look at what the limitations are. And sometimes getting that data based off, a fiscal year end reporting, it could be lagged somewhat, meaning you're not getting the most recent information of what they're doing today. A lot of the conversations we're having with clients right now, anybody who's gone through an asset allocation study just like you all have in the past, 6, 12 months is, going into COVID, everybody had to reach for return, right? They were taking more growth exposure in the portfolio. We're having a very, 180 conversation right now where, fixed income and any yield component of the portfolio is actually not a drag on the portfolio anymore. So you have an opportunity to go from, that 80-20 portfolio that you may have had before back to, a more balanced portfolio now. So you could look at the data, what comes out in the report, but it may not be representative of how they're invested today as well.
So if there are no other questions, we'll go to this sector piece just briefly. I think we only have about 5 minutes on the timeline, and we have Craig on the line as well. But I'll have an opening statement on this. We've done a lot of work to essentially answer the question, what does the sector exposure look like across the portfolios? And so there's good data in here on that. What's important to think about is your sector and industry allocations, in a sense, are a byproduct of your asset allocation. So if you just step away from passive versus active management for a minute and think about what have we allocated to U.S. equity markets, non-U.S. equity markets, fixed income markets, etc. You're functioning and making decisions at a higher level than what's your sector and industry exposure. You're making decisions at an asset class level, and when you think of it as when you buy an asset class, you're going to get that asset class's sector and industry exposure, and then those will vary depending on how actively you manage that portfolio. Managers who have been hired to be active will, not all, but many will make decisions about those sector exposures and where they might want to over or underweight. You've delegated that to an active manager. So if you think about it, at the highest level, you're making a decision above this. But that said, we've gathered a lot of data so we can look across the different components of the portfolio and look at what the overall exposures are like. So, Craig, are you there? Can you hear us?
Yep, I'm here. Thanks for that intro, David. Again, in the interest of time, I just want to go back to, there was a series of questions that led to this, and from a high level, the questions were, what's our sector exposure look like? How do we overlap between the different parts of the portfolio? Are we leaving ourselves over or underexposed to certain areas if there's a pullback in the economy? And essentially the crux of the question is there anything we should do about this? And I think to jump forward to the punchline, no, there's nothing to be done about this. Like David said, these decisions are byproducts of the higher level decisions, and as he emphasized earlier, focusing on the decisions that matter, these type of decisions have been delegated by your asset allocation and your manager structure and your manager selection. But it is similar to looking at how your peers are allocated, even if that isn't going to be an influencing factor in how you decide your allocation. It is good to look at data points like this and make sure nothing seems out of whack, and appreciate whoever's controlling the slides jumping to the main crux of the issue here is that you're well diversified across the total portfolio. You can see some footnotes there. We made some assumptions, for Lord Abbott being drawn down and the internal fixed income, which is managed, in line with the benchmark being ramped up. So most of this data is as of 9/30, but some of it is a bit more recent. So it's not a perfect picture. For example, in the real estate segment of the portfolio, we put that all in the real estate sector, but you can have very different risk exposures to different types of real estate. So sector gives you one idea, but information technology is a good example. You think of a tech company, exposure to Microsoft is not the same as a venture capital firm. It's not the same as a bond of a AAA rated, firm that falls within tech. The risk exposures are not perfectly aligned with the sectors when you look across asset classes, because the asset classes have different levels of security or risk baked into what level of the capital stack you're investing in. So while this is a good check to say, okay, we aren't extremely over or underexposed anywhere, and that the data backs that up, it's not really, this data isn't really meant to drive any decision. It's just one more way to kind of put the portfolio through a different lens and make sure that we're not overlooking something. So on subsequent pages, we have breakdowns of the individual asset classes, and just a high level there is, you look at something like US equity, you're very well aligned with a broad-based US equity index. No surprise, because you have a lot of passive and enhanced index there. You go down to international equity, you're a bit more active, you have a bit more variance. But all in all, the portfolio is not only well diversified, but not taking large sector bets in any of these different areas relative to an index. We don't have a good way to benchmark in some of the private asset classes, but even when you look in those, you see a good dispersion of sector exposures, which falls out from these most of these managers are probably building the exposures more based on the underlying security than trying to make sector bets, although some will have some macro level themes that lead them to lean into or away from a sector. Now I feel like I'm just rambling when I told you that the point was, succinctly, you're well diversified and roughly in line with your benchmarks when it comes to a sector perspective. Happy to
Thank
take
you,
it.
Wilshire. I appreciate the time to put together this information. I was one of the individuals who submitted questions on this topic, so I appreciate the effort that you put into pulling this together for us. Are there any questions on this sector allocation? Any questions on any of the other topics that we covered today? I really appreciate all the work that's gone into this session, and Wilshire has, as usual, does a great job of research and sticking to a timeline that we put together for him. So I appreciate those efforts. With that, I think we are ready to adjourn, so I'll entertain a motion to adjourn.
So moved.
Thank you very much, Dr. Hackford. Do I have a second?
Second.
Thank you very much, Mr. Foster. All those in favor of adjourning, please say aye.
Aye.
Any opposed? You can hang out with Wilshire. Thanks very much. I appreciate all the time and effort that everybody has put into this session today. I think it was an excellent discussion, and I appreciate all the time and attention. Thanks very much. Have a great afternoon.
Thanks, everyone.